Today, we're analyzing a high-conviction financial report that asks, will MBOT hit $8.75?
And it argues pretty forcefully that the answer is yes.
The core idea is that Microbot Medical is just fundamentally disconnected from its current price, especially with these huge commercial breakthroughs happening.
Yeah, this analysis report is already really strong. The energy is great, the structure is clean, and that whole disconnect framing, it just grabs you immediately.
It really does.
And I think the way it lays out the three massive catalysts right at the start, the MRE validation, the commercial stage transition, FDA clearance, that just immediately tells you why this matters now.
That's what makes the core claim so powerful, right? A stock trading around $2.18.
Well, analysts are looking at $8, $10, even $12.
That gap is everything. But, that gap also brings us to our first real opportunity for improvement.
To really elevate the high conviction, kind of contrarian angle, the report has to actively engage with and immediately rebut the market skepticism.
Right. I mean, if the claim is a 400% upside, but the stock is sitting at its lows, the first question anyone asks is, why?
Exactly.
So what's holding this back from being truly elite?
Well, the weakness right now is that the analysis sort of pins the low price on this idea that the market is sleeping.
Which is punchy. I get it.
It is, but it's not a real explanation. It doesn't answer why these massive catalysts haven't moved the needle yet. If the news is that good, the reader is thinking, okay, what am I missing?
And if the report doesn't answer that, it can sound a bit like wishful thinking.
For sure. So the suggestion is to strengthen the analysis by offering these proactive, immediate rebuttals to the most logical bearish arguments. You have to transform that passive disconnect into an active rebuttal.
You have to name the monster before you slay it.
Exactly that. It shows intellectual honesty, and it just massively boosts the conviction of the whole piece.
Okay, so let's talk specifics. What does that look like in practice? How do you name that monster?
Well, instead of just saying the market is wrong, you define the bearish argument right up front. You could say something like, the market is still pricing in fear of historical R&D cash burn.
Ignoring the shift to commercial milestones. I see.
Or maybe it's, the market doubts the pace of the limited market release and is waiting for more data points beyond just MRE.
That's a powerful shift. It assumes the reader is skeptical for a good reason, based on the company's past.
Precisely. And once you name that skepticism, you immediately refute it. You frame the MRE adoption as the direct counterargument. You show how that one event changes the whole equation and makes those old fears about R&D risk outdated.
So the MRE news isn't just a fact. It's proof that the bear case is running on an old model.
Yes. And I know what the counterargument might be. What if you define the bear case too specifically?
Right? What if some people are worried about reimbursement, not cash burn?
That's a fair point. But for a high-conviction report like this, specificity is authority. You go after the most common historical fear. And for a company like this, that's almost always cash burn.
Neutralize that, and you've removed the biggest barrier.
You've earned the reader's trust because you anticipated their main hesitation. That's how you build real conviction.
That focus on anticipation, it actually leads us right into the second area for improvement.
The execution risk.
Yeah, the analysis does a great job of pivoting MBOT from an R&D story to a commercial one. It's now purely an execution play. But that risk section, it just briefly mentions execution as a factor.
It needs more weight, absolutely. So given that the entire bullish thesis now hinges on successful commercial execution, the risk analysis needs way more specificity about the milestones needed in, say, Q1 2026.
So lay out the problem with the current approach for us.
The weakness is that it's just too general. Saying they have to sell the robots now, that doesn't really capture the challenge of a 450% upside, does it?
Not at all.
Execution is the core risk. If they fail, that 875 target is a fantasy. But it's treated like a minor point. The imbalance there, it weakens the whole analysis.
A risk section should be an investment roadmap, not just a boilerplate disclaimer.
Exactly. So the suggestion here is to integrate specific, verifiable commercial metrics into that risk framework. You need to give the reader a clear definition of what success or failure actually looks like for this execution play.
Okay, so give us some concrete examples. The report mentions needing more announcements in Q1 2026. How do we quantify more?
You could define it. Is the critical factor getting a second major academic center on board to validate the MRE data?
That would be huge.
Say, success is hitting 3 to 5 sites by the end of Q1. You give the reader a clear, measurable target to watch for.
For a medtech company, those high-profile centers, that validation is often more important than the initial sales numbers.
It is, because it de-risks the sales cycle later on. And to add another layer here, you could use that wide range of analyst price targets, $5.50 to $12, to create a tiered risk-reward assessment.
Oh, that's interesting. So you're integrating the risk directly into the valuation.
For instance, you could link that low-end target, the $5.50, to minimal execution success. Maybe they only get that second site. But then you link the high end, the $12, to really successful execution in Q1 that proves broad market acceptance.
So it acknowledges that the 875 target isn't just one finish line. It's a median based on a path of successful execution.
And it's not speculation, it's scenario planning. You're mapping analyst expectations to performance. It actually de-risks the thesis for the reader, because it shows that even partial success could still offer a compelling return.
I think a sophisticated reader would really appreciate that level of granularity. They want a roadmap for the future, not just a static valuation.
Absolutely. It makes the entire analysis much more valuable.
Okay, let's transition to the third area, the technicals.
Right.
The report has a really clear technical section. It identifies a support floor around 212 to 215, a breakout at 229. It's a clear buy zone, but it kind of exists in its own little silo.
It does. So the material can maximize its impact by explicitly integrating that technical buy zone with the core fundamental claim that the stock is trading at a pre-revenue price.
So what's the danger in keeping the technicals and the fundamentals separate like this?
Well, the weakness is that it just diminishes the urgency. The technical analysis feels like a separate section, almost divorced from that great narrative about buying a commercial stage company at a pre-revenue price.
The technical floor just looks like another line on a chart.
Right. It doesn't feel like a moment of profound opportunity. The reader is left to connect the dots themselves, and that just dulls the impact.
So we need to eliminate that choice. Don't make them choose between the financials and the charts.
Exactly. The suggestion is to frame that technical entry point, that 215 support level, as the physical, tangible representation of the entire fundamental value proposition.
So the technical floor becomes synonymous with the last chance to buy.
Yes. It fuses the two disciplines into one single cohesive argument.
That gives the technical data so much more authority. How would you actually execute that in, say, the closing remarks?
A really actionable step would be to revise the conclusion, state it explicitly. The technical support at 215 isn't just a chart floor, it is the price boundary of the pre-revenue opportunity.
Wow, that's a very urgent and very sophisticated way to frame it. You're assigning fundamental meaning to a technical level.
And you can take it a step further. Connect that breakout trigger, clearing 229, directly to the execution phase we talked about. You could say something like, clearing 229 will be the signal that the market is officially recognizing the transition from R&D to commercial growth.
And the gap to the 875 consensus target has officially begun to close.
Yes, that price point becomes the market's psychological acknowledgement of the shift. You're not just telling the reader where to buy, you're explaining why that specific price represents the ultimate point of undervaluation.
It unifies the entire thesis. This has been